Good afternoon. So I've been starting our sessions this week with a statement, if you like, and one where I thank you all very much for your support during these last difficult months since the tragic passing of LuxFLAG's general manager, Sachin Vankelas. Sachin was a great human being and a tireless supporter of sustainable finance, and really exemplified LuxFLAG with his passion, ambition, and drive to a sustainable future. So thank you again. As chairwoman of LuxFLAG, I'm very pleased to see that after 2 editions, the LuxFLAG Sustainable Investment Week has already gained recognition, and that's really thanks to LuxFLAG's associate members who are showcasing this week where they are in the sustainable finance journey. Clearly, we are all in different phases and stages of that sustainable finance journey, so this week is really about sharing best practices so we all advance towards the goal of making all finance sustainable. For this 3rd edition of the LSIW, thank you so much for your positive response. We have over 3,500 registrations for the entire week. And thanks so much to our partners, and including our host partners and media partners. The 25 sessions that we've been sharing with you this week cover the latest trends and most pressing issues in sustainable finance. Hopefully they are useful and inspiring as well in terms of the progress being made to helping finance find solutions to our current environmental and social challenges. A few housekeeping points. The slides and the recording of the session will be made available to you in a week or so. And for the Q&A, we seem to be having problems with the Q&A that you see on your screen here, but please put your questions in the chat at the bottom right of the screen. So I'm pleased to introduce this session hosted by State Street Bank International. The topic is focusing on the questions, how is ESG integration consistent with financial market theory and the experience of alpha generation in a portfolio management practice? I'd like to introduce Antoine Delporte, who is project manager of State Street, and Antoine will introduce the other speakers. So the floor is yours, Antoine. Thank you.
Thank you very much, Denise. And I'd like to start really with a big shout out to you guys at LuxFLAG. Thank you very much for organizing those events. I understand it's a really tremendous amount of time that is invested by your team. And it's always great to see all those companies gathered together and speaking about ESG during a whole week. So that's great. So just to introduce a bit our topic, I'd like to say that we speak a lot of sustainable finance, and in this word, there is the word finance, right? And finance doesn't work really without the appeal of making profit. So I guess the question we ask here is, what does it mean when it comes to integrate ESG factors? Basically, will I face a trade-off on my profit if I want to be responsible, right? And to explore this thematic, we wanted to hear the experience of practitioners, basically understanding how they combine responsible investment versus responsible objectives versus these profit-making objectives, but also to hear the view of the academic world and market efficiency theories, etc. What do they have to say about that? So we are very lucky, and we have gathered a very talented panel today to explore the question. For the academic view, we have with us Michael Heiling, who's a professor of finance at the Lux University. And actually, he's also teaching at the Certificate of Sustainable Finance by the university that I attended, and I highly recommend. And we are welcoming as well 2 seasoned investment managers, Remy Olupitan from Schroders and Nicolas Cortasa from Horizon Capital. But to lead this discussion, I will let the floor to our very own Rick Lacaille at State Street. He's our global head of ESG here. So I will pause here now, and Rick, the floor is yours.
Thank you so much, Antoine, and to Lux Sustainable Investment Week. Congratulations. I think Europe has a massive comparative advantage in this area compared to any other part of the world. As it capitalizes on that advantage, it will drive growth in our industry and in revenue, and certainly in Luxembourg, we should be a significant beneficiary of that. But we do have to keep sharp, and that's why this session, in my view, is really important. So what does keep sharp mean? It means we don't just say, well, we're ESG and in a sense regard that as a thematic, that has no connection with value added from a financial perspective. And often the financial industry does have a habit of attaching itself to thematics, driving a lot of revenue growth at the expense of long-term results for customers. And that's why the financial economics academic world is so important, because it throws cold water over those stories sometimes that come from the finance world. And it's really important we blend together the knowledge and, if they can say so, the sort of skepticism of the academic world with the practitioner's view, which is, I'm doing hand-to-hand combat with markets every day, and I can see opportunities out here, risks, many of which relate to ESG. So what we're going to explore is this kind of junction between financial market theory and practitioners. And financial market theory, as we know, is actually quite well developed, although the roots of it go back only probably 100 years. But most recently in the 50s and 60s, the development of modern portfolio theory, arbitrage pricing theory, and other asset pricing. Now, ESG didn't really get a look in there. And what I want to do is talk to Michael firstly. Michael, welcome as Professor of Finance at Luxembourg University. What does theory tell us about the role of ESG in price formation or product design, or in fact, indeed market efficiency? I will return to that subject later, but what does theory tell us about where ESG might fit into the whole question of portfolio management?
Well, thanks, Rick, for the kind introduction, and thanks, Antoine and Rick and State Street for the invitation to join this panel. So, I think the idea for this discussion, for this panel, is excellent, because I think exactly this intersection between academic work and the views in industry is very fruitful, and I think very needed, also especially in the area of sustainable finance. So, coming to your question, Rick, I think as you correctly pointed out, in the last 50, 60, 70 years, financial theory made a lot of progress in terms of trying to put a conceptual framework on top of financial markets to understand what kind of compensation investors can expect to earn if they participate in financial markets. And one of the key principles here is that basically you receive compensation to enter or to share or to basically bear risk in financial markets. And so in these theories, ESG was not one of the original characteristics to be considered. And I think it's also well known that in academia, I think there was some hesitation early on to kind of jump on this train about sustainable finance and to actually develop a rigorous framework to sort of model the interaction between ESG characteristics and financial markets. But in recent years, I would say that academia has tried to catch up. And I think there has recently been a couple of very prominent and well-cited and well-published pieces of academic research that show how ESG fits in. And I think these papers all point towards a very clear direction, a very clear implication of financial theory for the implications of ESG characteristics and portfolio composition, and especially expected rates of returns that you can earn in markets. And that is that if you invest in a sustainable way, so to keep it simple, if you invest in green stocks or green investment, then you should expect that your earnings, your expected earnings, will become lower than if you invest in brown assets. And the intuition for this sort of implication or this prediction that comes out of financial theory can be made in multiple ways, but one that I think is obvious, coming back to how I started this little statement here about risk, is that if you think about the riskiness of these stocks, right? If we think about physical risks that are associated with climate change, if you think about transitional risks that are related to regulatory changes, to tax implications of, for example, carbon dioxide emission taxes, then basically you would conclude that green assets are less risky than brown assets. And as I said earlier, the way we think about financial markets is you earn compensation for taking on risk. So if you invest in green assets and they are less risky than brown assets, you would expect to earn lower expected rates of returns. Another channel that I think is very important in this context that I would like to briefly comment on is that we also have seen within the investor space a huge shift away from neutral investment strategies towards green investment strategies. And that, of course, also means that there's few investors nowadays around that are willing to invest in brown assets. And that means that this risk-sharing capacity that financial markets add to the economy is going to be lower for brown assets, which means that their prices will have to drop in order to offer these remaining investors that are still willing to hold them higher expected rates of returns. So you see the same mechanism that basically brown assets basically have to promise higher expected rates of returns to still motivate those remaining investors who are willing to hold them to actually invest in them. And the last statement I would like to kick off this discussion is that, of course, investors shift their preferences towards sustainable investment because they also want to contribute to this transition towards more sustainable economies. And that, of course, means that shifting your financial investments must have an impact on the real economies. It must have an impact on the project that these firms are doing. And then it must have an impact on the cost of capital of those firms. And if you want to have an impact on the cost of capital of firms with your investment decisions, then you have to see exactly this. You have to see that the cost of capital for green firms become lower so that they are supported in making their investments, while the cost of capital for brown firms have to increase because they should find it more difficult to continue with their current projects because they have to earn higher expected rates of returns. And that's exactly the mirror image of what I described earlier for the expected rates of returns of investors.
That makes perfect sense, Michael. But can I ask a question relating to where we are in this journey? Because maybe what you're describing, if I put words into your mouth, is a sort of new equilibrium in which brown assets are risky, all the information's out there, green assets are less risky, and therefore investors will be willing to earn less return because they'll have less fundamental risk, less left tail shocks. But are we in an intermediate position where the market is not efficient in relation to ESG or climate risks, and that there's mispricing, and that therefore somehow people are gaining an advantage and seeing extra returns from green assets because they're in the middle of this sort of behavioral bias driven mispricing? I know I'm putting words into your mouth, Michael, but I mean, the question is, where are we? Are we in equilibrium, or are we in a sort of immature state in terms of market efficiency?
Rick, I think you're perfectly right. So I think we're in a transition phase. And I think that's also when you look out there and there's like hundreds or thousands of studies that try to look at empirically at realized returns of green investment strategies versus brown investment strategies, they oftentimes find that green investment strategies perform better. And I think that's exactly because we're currently in a transition phase. I would not necessarily call this to be behavioral driven. I think what financials here will tell you is that actually what we observe is that there is unexpected shocks to investor preferences. So I think sometimes markets might be surprised by how much investors are actually moving into green investments. And because more investors move more quickly into green investments, that pushes prices up more than expected. And that yields to this pattern that we see in the data that the realized returns of green investments look very attractive right now. In equilibrium, which we should sort of reach at some point in time. However, we would be back in what I said earlier, that in the longer run, the expected rates of returns of green investments should become lower.
So let me now turn to our practitioners. We have two great investors with us, Nicola and Remy, and they're dealing with a lot of uncertainties. I mean, inflation might be an obvious one where you say, well, we're not in an equilibrium position, possibly with inflation. But if you come back to this question of ESG and climate risk, Nicola, are you seeing this as an opportunity alongside all the other potential information-driven opportunities that you've got in front of you? And how does the low correlation of the data, because we know that we've got good data in some areas of finance and bad in others, does that make it an attractive place where the data quality is poor and you can get rewarded for your homework, or just a headache?
But all in all, I believe that going forward there are plenty of opportunities for ESG. I believe that a really important premise that when we talk about ESG, data has been an issue in terms of quality, comparability, and availability. And at the same time, this lack of information has faded perhaps in the last 5 to 10 years. So perhaps also a lot of empirical results might lack the robustness of dealing with a longer time period in terms of data and so on. And on top of it, there is what you just mentioned, that the realized correlation among ESG ratings tends to be quite low as compared to what we might have, for example, for credit rating agencies. As per some studies, the correlation among ESG databases stands close to 0.5 as compared to the other one, which is 0.99. And this has mainly a twofold implication. Once again, from an empirical perspective, this once again hampers somehow the robustness of result, because it might lead the fact that if we conduct the same study in terms of time frame, investable universe, but we apply a different ESG data set, then we might find conflicting result. And so if we want to try to summarize the whole literature that has been building around whether ESG were able to overperforming on an absolute or risk-adjusted basis, the general evidence is that we cannot conclude such a claim. It's also true that all in all, for those studies that tried to find evidence of outperformance, they weren't able to find evidence of underperformances. So in order to conclude it, at best, they will provide something more. At worst, which is also the central case scenario, they should provide more or less the same risk-return profile of comparable investment while focusing also on the ESG spectrum. So there is still this dual mandate. And from an empirical perspective, right now, because of this low correlation, it might be that the fact that right now investors have a preference towards ESG, but the way this preference is expressed because of its diversions might be an impediment to the market to properly take it into account. And right now there is also all this phenomenon for which there are a lot of initiative regulators worldwide, which are really welcome and warranted. But right now still the whole set of choices and possibilities is so broad that perhaps the market could still find some difficulties in pricing all of them. So I believe that this could be two of the most important explanations if you want to claim any kind of inefficiency in terms of ESG. But going forward, I believe that the next 10 to 5 or even 20 years will be dramatically different than the last 5 to 10 years, because the shift in attention is real, is huge, is important, it's happening at a fast pace, always at a faster pace, and still the overall amount which is invested in ESG is low compared to the total capital which is available. So there is plenty of room to go from that point of view. And I believe that going forward, one of the most important levers will be also much more clarity from a regulatory point of view, which will shrink the whole set of scenarios that are still available. And perhaps the market will start to reflect ESG information, perhaps in a much cleaner way than before.
Yeah, well, we certainly have that in Europe, but it's not true in all parts of the world. I think we may see more soon in the US. But you paint a picture of growth towards this equilibrium. Perhaps I can ask Remy, as you see growth in ESG, is there this paradox where its power becomes diminished because it no longer becomes a good source of differentiation between individual stocks somehow, that everybody knows about it? So how do you see it changing? And is that growth trajectory one that worries you from a return generation perspective, or is it part of a healthier long run trend?
Oh, wow. I think definitely we have seen a remarkable growth trajectory. Certainly in the last 5 years, it's unprecedented. And whenever there is growth, there is a change. So the definition of ESG investing today is very different to 10 years ago. So we've certainly seen a shift from avoidance to working with companies. So 10 years ago, it was really about negative screening, what you don't want to own. But right now, given that growth and that demand, investors have to think about it differently. And the way investors are thinking about it actually requires more differentiation, because we've moved into an environment where you have to identify those companies that are truly changing their business practices. And I think one of the issues that you may have with growth sometimes is that there is a risk of greenwashing, because now that we all agree with the principles of ESG, there is a risk that a number of companies also agree with it, but don't actually do anything about it. And that is where we are at the moment. So investors really have shifted towards actually holding companies to account. And I think that that's where we're going to see more growth in the future. and that will require a lot more differentiation. The only problem with that is that it's easy to say. Actually doing that is hard. We don't necessarily have the easy data to do it. So that is a challenge. But that in itself means that there are still a number of opportunities for investors to pick the winners and the losers, the right companies, the companies that will continue to exist within this new regime of ESG.
And do they keep, they keep looking for more data? I mean, you mentioned data, and I think we're going to get really into that subject for a while. It's not mandatory. Regulators in all parts of the world don't necessarily require it. And the most useful data might be forward-looking data. But as ESG grows, and as you mentioned, goes more sophisticated from negative to positive screening, and people looking for more and more ways to differentiate companies, what's the data response to that? Where's the data going to come from? And do you think we are going to see better data and therefore more opportunity? Is that a field that's going to expand further?
Definitely. We are a bit behind in terms of the data. So I think that the data is behind the trend, but that is a gap, and it's an area where more development is required. One of the reasons why the data is a little bit behind is that ESG can still be a little bit subjective. And so we still don't have standardized ways of measuring ESG. And so that is one of the reasons why the data and analysis is a little bit behind. So there is still some more subjectivity and opinions with regards to the data. But when we want to manage something, we need to measure it. That is the principle of investing. If you want to manage, you need to measure. And in order to measure, we need to have data. So I think that there will be demand for an improvement in the data, but it's certainly behind at the moment.
And just to pursue that topic a little bit more of the downside risk, reputational risk is something that many suggest is sort of the trigger to get returns. I mean, in other words, to avoid bad reputational risk is actually pretty useful, but it's a bit like the invisible piece of data until it comes up and bites you. How do you think about reputational risk, and is that part of your overall strategy as you think about different asset classes that you're investing in?
Absolutely. So reputational risk is something we think about in two ways. First of all, from a risk point of view, it's about ensuring that we are doing what we say and moving away from this idea of greenwashing. I think greenwashing is an area of reputational risk, and it's very important that investors are able to evidence exactly what difference they're making from an ESG point of view. And I think that is an important area of reputational risk. The other area when it comes to reputational risk is, who are we investing in? And are these companies going to be held to account by consumers? So we've moved into an environment where reputational risk isn't only coming from the regulators, particularly when it comes to the environment and social factors. A lot of consumers will hold companies to account. And that is a major reputational risk. And a lot of companies face an existential threat today because of that.
So that's, I mean, I think that's a completely believable hypothesis, and I certainly subscribe to that. But proving it, and maybe this is now back to Michael, where we've got these short data sets. I mean, if you say, well, the hypothesis is that companies with certain characteristics are bearing a hidden risk, a reputational risk. Empirically, where are we with data, with finance on this, in this area? Is it getting any better? How do you deal with it from an econometric perspective? Are there techniques you can use when you've got short data sets or missing data to deal with it?
Those are very hard questions, Rick. I think you're absolutely right. So as was pointed out by Nicola and Remy, I think the data issue is a big issue, especially if we want to establish or derive robust empirical estimates. We all know that if we want to come up with estimates of average returns, we need a long time series. These estimates are noisy, and if we only have 5 to 10 years of data, it becomes really tricky. And then, of course, you also mentioned this in one of your statements earlier. Data providers are trying to come up to refine the data collection and data processing procedures to come up with forward-looking data and data items. But that, of course, means that the more the methodology gets refined, the more we lose the time series dimension, right? Because suddenly the data that I had 3 years ago is not comparable to the data that I have right now. And so again, I cannot use the current data to actually evaluate ex post whether conditioning on that data would actually help me identify a good investment. I think what we try to do academically to mitigate some of these issues is that we try to exploit what we call cross-sectional variation. So we try to look across asset classes. For example, look at equities, fixed income, other asset classes to see whether patterns that we find with this relatively short data also hold for these other asset classes. You can also exploit cross-country variation, compare, for example, empirical results for the US to other markets in the world and see whether the results go in the same direction, which would give you some more confidence that even though your estimates are noisy, that you can rely on them. So there's unfortunately no magic trick that I can offer from the academic side to deal with this. But I think with some of these nuances, you can get some more confidence into the data.
But we know from first principles that data is important in decision making, and now regulators are looking at it. Obviously, in Europe, taking the lead with the taxonomy and various other issues. But maybe a question for the practitioners and for you, Michael, as we've got more mandatory data disclosure on the horizon, what are the most decision useful data sets that are not yet mandated? Because I think there is a desire to put a lot of ESG data out there, but the question is it useful for making decisions as an investor? Remy, do you have an initial comment on that? And then I'll move to Nicola.
I think it is useful. It's very useful. It's certainly useful when it comes to comparing companies on a like-for-like basis. The types of data that will be useful is companies opening up more with regards to their goals and how they're aiming to transition, certainly with regards to the net zero target and decarbonisation, having a standard set of definitions in terms of what that means, that will be very helpful, because a lot of investors right now are focused on that transition towards that target. So hearing the same from companies and the same definitions will be helpful. The area that we struggle with the most from a data point of view is on the social side. And this is the big challenge. Social factors like the treatment of employees, diversity and inclusion, that is more challenging. And this is where, as analysts, it can be quite difficult. You can be given one data, but it's difficult to test that data. And this is an area where we definitely need more work.
It's interesting. I think that is on the, so to speak, the shopping list for the SEC in the US, climate data and human capital data. So we'll see how that turns out. Nicola, what would be on your wish list? I know you blend, maybe you can talk a little about your investment process, where you are actually blending factor-based investing, or at least factor control, together with ESG. What would be useful data for you?
But clearly, I believe that the most useful data will be everything that relates to materiality, as far as we are talking about firms at the firm level. I believe that at the same time, too much of a rigid approach in terms of what is mandatory disclosure is not really warranted, and perhaps is not really welcome, because otherwise the risk is to divert money and time of firms from might be something that has more of explanatory power for themselves too. I believe that all in all, the biggest winner within the ESG component for now has been the E component, so the environmental one. There are a lot of things that still has to be done through the social lens. So perhaps also the expansion of the EU taxonomy into a social taxonomy might be a really welcome approach going forward. While I believe that all in all, governance consideration have been of the utmost importance all over the world and always. because those are pretty, I mean, within the G sector and segment, perhaps all of the considerations are important because they tend to be all material, while on the E and the S, there could be some discrimination of it.
And Nicola, when you think about materiality, I mean, you mentioned the taxonomy, but there are efforts globally to pin down what's financially material, starting with the SASB, which is now the VRF, but maybe followed by a number of other initiatives. Do you find them useful approaches, or would you err towards the more regulated approach that EU's taken, where it's basically a policy-driven approach to what should be material?
I believe that too much of rigidity and too much of flexibility is not really warranted, because at the same time, you need to be able to make comparison within the same industry and within the same perhaps investable universe. I believe that all in all of these mandatory requirements are really welcome, because they're anyway increasing the supply of ESG information. It will be important to try to maintain a certain quality of information. And at the same time, I believe that one of the development within this thematic is that for now we have a lot of spontaneous ESG disclosure by mainly big companies and companies that are already scoring well on the ESG spectrum. So perhaps this mandatory disclosure will benefit the margin, mainly companies that clearly now are not disclosing the information, but that at the same time they tend to have lower ESG score comparing to others in the same perhaps investable universe. So I believe that in terms also in price, for a possible price discovery mechanism, the highest benefit will come perhaps for those companies that right now are scoring in the lowest bucket of the ESG rating.
So, I mean, Nicola, you raised an interesting sort of policy question, and I think Michael, often academics and universities are asked to adjudicate when policy is being designed because they're not financially motivated. In other words, we've all got a dog in the fight. We're managing money or we're launching funds or whatever. But academics, if I can say, are more dispassionate. Do you see the data issues through the lens of market efficiency, or is it, for example, consumer awareness driven, that it's important that we get more information out there so that many, many more people, not just financial markets, can see it?
So Rick, let me just clarify that I'm very passionate about sustainable finance, even though I am an academic. But I know what you're talking about. I think that is obviously the beauty of being in an academic institution, that sometimes you can at least appear or pretend to be more objective, right? Because the incentives are maybe different. But I think the data, so I wanted to make a couple of points. One is, I think what you brought up earlier about the mandatory nature of data, I think is very important, because one of the key challenges that we face in academic research is that if we exploit the time series, the history of the data that we have in the ESG space, it is self-selected, so firms select to report this data, and then that means you inherit all these biases. For example, size, which is a huge bias in the older data. There's only the large firms that actually had the resources to report and fill in those questionnaires. And that, of course, distorts all the analysis that you can do over longer time series. I think another aspect that I wanted to briefly bring up is about the focus. And I think you already see this in our discussion here when Remy emphasized the social dimension. And then Nicola also talked about the G dimension, the governance dimension. I think these are very different aspects, different problem sets. I think they require different data collection efforts. I think it's a very different challenge to report emissions and get the level 1, 2, 3 emissions on the right, than to think about social dimensions such as human rights violations, or even mixing governance, which actually is an old topic, right? I mean, governance goes back 25 years. And actually on governance, we have lots of evidence about the importance. And I agree with Nicola that these aspects are material that has been documented. So it's a different animal. I think one question, coming back now to your specific question to me about regulation versus maybe having a more market-oriented approach towards the data collection. I think it's a question also about urgency and efficiency, right? I mean, if we kind of try to let the markets play out about what is the material data that actually investors are caring about and that turns out to be material for financial returns, I'm not sure we might have enough time to kind of let the market play this out. Maybe it is important to have a more organized, maybe to some extent centralized approach that says, look, in the environmental aspects, for example, to fight against global warming, you need to measure these kind of data items because they are the ones that are responsible for global warming. So we need to keep them under control. And that needs to be, I think, imposed, so to speak, because it's also interdisciplinary. It comes from other aspects, right? It's not just a finance question. The question comes from natural sciences. And so in that respect, I think for some of these topics, maybe an approach that is more regulatory oriented might make sense.
Yeah, understood. So maybe turning to Remy again, that we've got this sort of multi-year trend. I think you were extending it into a multi-decade trend of ESG. How do you position that trend? And again, I think it was interesting, this discourse about different components of ESG might be more relevant to different investors. Do you think that'll be an enduring part of the trend that we'll see actually quite a lot of differentiation between asset managers as to what they specialize in and, you know, in a sense, they're very strongly held beliefs?
Definitely. I think investors have certainly moved towards wanting to see the impact. And when investors want to see the impact, sometimes it's cleaner to split that impact. So, for example, a lot of investors want to see focus on a portfolio that focuses on climate change and is really targeting that transition towards a net zero world. And so investors just want to see that impact. It could be in the case of more social factors. And so we are seeing that from a lot of our investors. There has been a shift towards impact investing, which is a challenge in the public, in public markets, but it is also inextricably linked to this idea of evidence-based investing and focusing on the outcome. Investors are, right now, a lot of our clients understand the philosophy, they understand the principles, they want to see it in action. And that is why we continue to believe that impact within public markets is an area that will gain a lot more traction.
So, but we know, I mean, for example, I know in your multi-asset portfolios, you continue to push the envelope, into new areas of credit, for example, private assets, where there's a much more significant deficit in data. And yet, particularly in private equity, the general partners have enormous power over the companies, so they can actually change them quite easily. So do you see ESG playing out differently in those private markets, either for better or worse, than the ones that are listed, which often are much more in the eyes of regulators and others?
Absolutely. Certainly this idea of impact investing works a lot better in private markets. And that is because investors have more control over the business and the direction of capital. But in public markets, we can advise, we can suggest, we can recommend, but we don't have that ultimate control. But within private markets, you're definitely seeing this. And an area where we're seeing a lot of impact and clear outcomes is certainly within real estate and infrastructure. Infrastructure assets can be very much linked to the energy transition theme. In real estate, as an investor in real estate, either as a developer, there are things that can be done in order to ensure that a particular building is aligned with the net zero target. So certainly within the infrastructure and real estate side of things, impact investing has grown by quite a large amount. In private equity, there is a buy-in right now in order to move in that direction. Private equity, the challenge is really on the social side. So that is an area where private equity still needs to make a lot of improvements, but the commitment is there, and we are seeing a positive trend.
Thanks. Now, Michael, I'm going to misquote you, so don't shout at me. But one of the things you said in Equilibrium, and I'm going to exaggerate now, is that brown assets will be, they'll have risk, but they may offer higher returns, and green assets will, the risks will be lower, and possibly the returns will be lower as well. But one of the questions is whether this goes too far, and I'm going to ask Nicola about this question of whether there is a chance, and again, leading the witness, is there a chance of a green bubble? And if there is that actually a good or a bad thing, in the sense that if you get green assets, and we see this in the green bond market with the greenium, as they call it, is that a good thing in the sense that it channels a lot more assets, and it's evidence that a lot more assets are going into the right place? Or is it a bad thing in the sense that ultimately bubbles always burst, and then it's going to cause even more trouble in the long term? I know it's a difficult question, Nicola, and I'll go to the others as well, but let me ask you that question. Chances of a green bubble, and is it good or bad?
Well, if we start by analyzing ESG equity investment and standard ESG equity indices, we cannot really conclude that a bubble is going on, because if we take current valuation, there is not really much to difference with parent and more known indices worldwide. It's also true that one aspect that has been happening recently is that the valuation premium of high ESG rating stocks relative to low ESG rating stocks has been narrowing relative to historical standards. And so this could also be an indication that the market within the equity domain is taking, or is starting to take, a more granular approach in investing, not focusing only on what is leaders, but also what is improvers per se. It's also true that if we take some specific equity pocket of the market, such as renewables, for example, it's true that if we take, for example, the performance that they had from the end of 2019, at the peak that they had this year in January, they had a massive outperformance of plus 180%. By outperforming the Nasdaq, for example, by 80%. And right now they are trading with a drawdown which is currently around 35%. A drawdown which has been a healthy correction because it was mainly driven by multiple compression and further earnings expansion. So it was kind of a healthy one. But still, even though this earnings estimate does not materialize in the future, I believe that there could be some choppy session that could be still possible going ahead. But all in all, I don't believe that as we talk about general valuation, even in this pocket of the market, even if they are stretched relative to their historical standards, they are really, I would say, compliant with being considered as a bubble per se. Then if we have to move on about trying to find positive aspect of bubbles, clearly, when you talk about bubbles, we talk about something which is irrational. Perhaps there is exuberance, and at the end will lead to some losses of capital, mainly for investors and so on. But perhaps if we, as investors, try to broaden our perspective, and if at the same time this bubbles does not involve the leveraged finance sector, such as banks, because otherwise scarves in the economy might last longer. Then, and if we broaden our horizon, not from only being an investor, but also from macroeconomic point of view, then if they're able to leave the overall stock amount invested in the economy or leave a higher productivity, even if they're bust, I believe that this could be possible aspect of bubble per se. I mean, right now we are talking for internet, and if we think about it, during the dot-com bubble, a lot of fiber was put on the ground, on the sea. A lot of investors lost their money, but anyway, those were the precondition for our digitalized economy. So clearly, there could be some positive aspect.
Remy, just briefly, any sign from your multi-asset perspective that we've got bubbles brewing out there, or are we going to have a green bubble?
When you have a trend like this, it's typical to have a bubble because valuations are very difficult to assess. And typically a lot of these assets will trade at elevated valuations because we have to look forward in terms of their potential growth. So the energy transitions theme is an area where valuations are elevated and one has to take a long-term view on potential returns. So I do think that there are risks of a bubble, particularly at the moment with regards to stranded assets being ignored. So what I mean by that is at the moment, ESG still emphasizes this idea of negative screening. We're slowly moving to incorporate positive tilts, but negative screening is still prioritized. And what that means is that stranded assets that are not looking very good from an ESG point of view, a good example is the energy sector, will be avoided in favor of assets that look very well. It means that investors need to be wary of short squeezes, as we're seeing today, particularly if that comes with this idea of green inflation, which is the theme that I'm hearing at the moment. And so that presents a challenge for investors.
Yeah. And Michael, do you see green bubble? I mean, do you study bubbles, firstly, from a financial market perspective? And does this look like it's an environment where you could get them?
So absolutely, I think that's one of the core questions in academia, is obviously to see whether we can find ways to consistently identify bubbles in asset markets. But I think the conclusion of that literature is that it's very hard and very challenging, and usually you only know it exposed when the bubble bursts and you get the correction. So I think I agree with Remy and Nicola that I don't see very strong indications of bubbles. Again, in general, it could be for individual sectors, individual parts where maybe there's stronger patterns. We did a relatively large study, for example, on corporate bonds and on kind of like the premium of corporate bonds issued by green or high ESG firms. And you see there's a premium in the sense of they can issue their bonds at a higher price. But these premiums are currently in the range of, let's say, 20 to 30 basis points, which seems not unwarranted if you factor in that there might be differences in risk, as Remy mentioned, with respect to stranded assets, with respect to other risks related to the ESG dimensions. So from my perspective, I think bubbles are usually have a negative connotation because usually when market prices deviate from fundamentals, that's not a good thing. But I like Nicola's example of that it could also stimulate sometimes more investments that otherwise you would see, and they could have positive consequences or positive externalities in the long run. I think that's an interesting argument. Right now, I don't see strong evidence or indications for a bubble with respect to ESG investments, or the pricing at least with respect to ESG dimensions.
And maybe also one takeaway, Michael, is again, the point made by Nicola is that when it's an equity bubble, it doesn't necessarily become a systemic issue. When it's a credit bubble, it can have much more serious ramifications. How do you read across to green? Because a lot of the green infrastructure will be debt financed. So we're going to see a higher likelihood of a sort of credit-related bubble than an equity bubble that you saw, in the tech world back in 99, 2000.
So I agree. I don't know if the question was going to me, but I completely agree that obviously the debt markets are the ones that are more relevant from a systemic perspective, also just in terms of magnitudes and in terms of how they are interrelated to the whole economy. One of the risks that I see in the context of infrastructure investments particularly is, of course, the role of governments and subsidies and other kind of, the governments or policymakers interfering with the markets and the market pricing by basically following their agendas, because that, of course, could contribute towards the development of a bubble, or also partly inefficient investments or inefficient directions.
We're actually quite close to where we may be finishing, so I want to be rapid now. Michael, what are the new frontiers for the academic world in ESG?
Well, I think in our case, it's really about basically making this last step of documenting that any of the patterns that we see in asset markets in terms of shift of investor preferences and the ESG characteristics that are considered in asset management, whether these kind of developments, the consequences that they have on the portfolios, whether they will be big enough or strong enough, potent enough to actually have an impact on the real world, on the real economies, and whether they're going to actually contribute to this transition towards more sustainable economies. We right now have very little empirical evidence that kind of backs this up, that kind of shows these consequences. Of course, this takes time, right? Because now we have seen the shift in capital, but then firms have to respond to it, and you should see the shift in their projects, in their investment. And currently, I think that's a strong focus within the academic research to study those. And the second big aspect is what Remy mentioned earlier, is basically to find ways to detect greenwashing on all aspects, on the firm side, on the asset management, the mutual fund side, to make sure that with all the reporting and all the data that is currently flooded into the market, that we find smart ways to detect those that are doing a good job and disentangle and distinguish those from that just do greenwashing and don't really have any impact.
Well, that's an important mission. I certainly agree with that. And Remy and Nicola, just maybe reflect on emerging markets briefly. Nicola, I know that you're primarily invest and develop, but is EM a more attractive area because there's so little data, and also the companies themselves could improve much more than those you see in developed economies? We can't hear you, Nicola.
Nicola, you're muted.
There you go.
Yeah, I'm sorry.
Perfect.
Okay. If I was saying that if we try to invest in EM with an ESG lens, it's like combining two mega trends in one only thematic investment. I believe that the rationale for investing ESG in EM with an ESG lens is the same one as DM, but a much more flexible approach is warranted because we should take into account all the discrepancies that we have at the country level, because also of the less integration that we have relative to developed market. At the same time, as we said before, and perhaps by quoting also Remy on the private equity segment, I believe that the governance factor in EM might be really important, because on average, EM equities are only 50% in terms of free float relative to DM, which are 90% of free float cap. And so basically, when you are investing in a company in emerging, you are a minority shareholder. So you need to involve yourself with the main shareholder, understand which is the main direction, where there are a lot of issues that could really play out and affect your investment. But it's also true that this dimension, the G dimension, has always been important over there. And so clearly, most of the benefit could come from the E dimension, while the S dimension, I believe, will be really important, but right now the main focus will be on the E segment of the market, because more data are coming out, perhaps because companies are part of supply chain, and so they are already requested to having higher disclosure, perhaps even ahead of local regulation, because being part of supply chain means that consumers in developed market are requiring to disclose this information.
Yeah, and finally, the last word, Remy, just on EM. Is that an area where you see the big opportunity for improvement and alpha?
Absolutely, and just as Nicola mentioned, on the governance side, it's a bit of a challenge, but on the environment and social factors, we see a lot of real good prospects there. I think what's interesting about EM is that there is an overlap between ESG and technology. That is where we're seeing a lot of really interesting opportunities and the ability to actually focus on impact. So the technological advancements and ESG is really coming together in EM. So a lot of potential there.
That's a great note to finish on. I'm very optimistic. We've covered a lot of ground. That was fantastic, having an academic and practitioner perspective, and I hope would give investors confidence if they're able to listen into that conversation. Let me hand back to our host and thank our guests. Thank you so much for being stimulating and having a great conversation. Denise.
Thank you, Rick. Yes, and thanks to the excellent discussion, excellent speakers, obviously, and we obviously could have kept going. So clearly, this is a topic discussion to be continued. Thanks again to State Street Bank International for hosting the session. And thanks to the LuxFLAG team for making it all happen. I'd just like to end the session with a quote I hope will resonate with everyone. We now understand that sustainable finance is not just another type of investment, it's a complete shift of mindset. So I'm sure the speakers probably would agree with that comment. Our next session will start at 4 in a few minutes, hosted by Arendten Metternach, and focuses on carbon credits and investment funds. But thanks again very much for your participation, and to the speakers and to State Street. Thanks very much. Take care.
Thank you.
Thank you.
Thank you.
Thank you. Goodbye.
Goodbye.